1 minute, the stock market's hitting record highs. The next, blammo. We're in the throes of a stock market correction. While the coronavirus outbreak is the primary driver behind the latest market turmoil, the stock market doesn't require a pandemic to enter into decline. Market downturns are normal and can be caused by numerous factors. The stock market is going to crash at some point. There's just no way to know when. So what if the stock market crashed tomorrow? If you're a subscriber, well, welcome back to Investing Few. But if you're new to this channel and you want to enjoy more of our engaging content, make sure to click that subscribe button and use that trigger finger by smashing that like button. Now let's get into it. Understanding that a crash could happen in the future means you can plan for it today. Here's a 5-step game plan for what to do while you're in the thick of it. 1. Trust diversification. When a market decline hits, your results may vary, and perhaps for the better, if you've invested money across different baskets of asset classes. Sit tight and trust that your portfolio is ready to ride out the storm. If you've gone with a, quote, set it and forget it strategy, like investing in a target date retirement fund as many 401k plans allow you to do, or using a robo-advisor, diversification is already built in. In this case, it's best to sit tight and trust that your portfolio is ready to ride out the storm. You'll still experience some painful short-term jolts, but this will help you avoid losses from which your portfolio can't recover. So if you're a do-it-yourself type, even simple diversification, e.g. 70% of your money in an S&P 500 index fund and 30% in a diversified bond fund, will provide some cover during a crash. When the dust settles, you'll probably need to make some adjustments to that mix, aka rebalance your portfolio, since it's likely to have been thrown out of whack. 2. Remember your appetite for risk. Even though the stock market has its roller coaster moments, the downturns are ultimately overshadowed by longer periods of sustained growth. That's the reality on paper. If only our brains accepted that and didn't trigger emotion-driven reactions, like selling during market dips and possibly missing the eventual uptick. Investing in the stock market is inherently risky, but what makes for winning long-term returns is the ability to ride out the unpleasantness and remain invested for the eventual recovery, which, historically speaking, is always on the horizon. You'll be able to do that if you know how much volatility you're willing to stomach in exchange for higher potential returns. Ideally, at the start of your investment journey, you did risk profiling. If you skip this step and are only now wondering how aligned your investments are to your temperament, that's okay. Measuring your actual reactions during a market agita will provide valuable data for the future. Just keep in mind that your answers may be biased based on the market's most recent activity. 3. Know what you own and why. An emotional reaction to a temporary slump isn't a good reason to dump an investment, but there are some good reasons to sell. Part of doing stock research is crafting a written record of the strengths, weaknesses, and purpose of every investment in your portfolio, and things that would earn each a place in the outbox. During a market downturn, this document can prevent you from tossing a perfectly good long-term investment from your portfolio just because it had a bad day. It's like an investing roadmap, a tangible reminder of the things that make the stock worth holding. On the flip side, it also provides clear-headed reasons to part ways with the stock. 4. Be ready to buy the dip. Market dips are when fortunes can be made. The trick is to be ready for the fall and be willing to commit some cash to snap up investments whose prices are dropping. Be willing to part with some cash to snap up investments that are in the process of dropping. You probably won't catch the stock at its low, but that's no problem. The point is to be opportunistic on the investments you think have good long-term potential. Keep a running wish list of individual stocks you would like to own. Set aside some cash so you're ready for a flash sale when disaster strikes. Don't be surprised if you freeze in place during the moment of opportunity. One strategy to overcome the fear of bad timing is to dollar cost average your way into the investment. Dollar cost averaging smooths out your purchase price over time and puts your money to work when other investors are huddled on the sidelines or headed for the exits. 5. Get a second opinion. Being an investor is rewarding when the stock market's on a tear and your portfolio is going up in value. But when times get tough, self-doubt and ill-advised tactics can take root. Even the most confident saver investor can fall victim to harmful short-term thinking. Consider hiring a financial advisor to kick the tires on your portfolio and provide an independent perspective on your financial plan. In fact, it's not uncommon for financial planners to have their own financial planner on their personal payroll for the same reason. An added bonus is knowing there's someone to call to talk you through the tough times. We're done with planning what to do in case of a crash. Now, let's head on to what to do and what not to do during a crash. What not to do in a crash. During a crash, don't give in to the temptation to sell. It's like trying to catch a falling knife. A stock market crash will make the individual investor sell at rock bottom prices. That's precisely the wrong thing to do. Why? The stock market usually makes up the losses in the months following the crash. When the market turns up, sellers are afraid to buy again. As a result, they lock in their losses. If you sell during the crash, you'll probably not buy in time to make up your losses. Your best bet is to sell before the crash. How can you tell when the market's about to crash? There's a feeling of, I've got to get in now or I'll miss the profits, which leads to panic buying. But most investors wind up buying right at the market peak. Emotion, not financials, drive them. What's the solution? Keep a diversified portfolio of stocks, bonds, and commodities. What to do in a crash? 1. Protect yourself by rebalancing. Rebalance your portfolio as market conditions change. If you've done this well, then you sold off stocks when they've gained in value. If the economy does enter a recession, continued rebalancing means that you will buy stocks when the prices are down. When they go up again, as they always do, you will profit from the upswing in stock prices. Rebalancing a diversified portfolio is the best way to protect yourself from a crash. Even the most sophisticated investor finds it difficult to recognize a stock market crash until it's too late. 2. Be patient in a crash. You can't do the kind of investing I do and that I want you to learn how to do unless you're okay with sitting in cash. You need to be able to be patient. Sitting in cash means keeping your money in your money market account or in short-term bonds. Something where you can get your hands on it if you need to. You have to be willing to do that for a period of time while you're waiting for these fluctuations in the stock market to come along. This is where the average person can jump over 6-inch bars because the market is going to give you those 6-inch jumps once every 5 or 6 or 7 years. Sometimes it happens more often. 3. Be ready to load up when it happens. Third, when it does happen, you've learned enough about a few companies that you can load up the truck. This means that you've researched and found some wonderful companies that are going to go up when the market comes back. You buy them and get a great deal on them. 4. When the market goes to the other extreme, be ready to get out. 4th, when the market goes to the other extreme, which is where it's been lately, be prepared to exit and go back to cash. You have to be ready to sit there for 3 years while it continues to goes up, because you don't have a crystal ball and you don't know when it will drop. All you know is that it is going to drop. 5. Don't be greedy. This is where these big rates of return come from. Obviously, fund managers can't do this. They can't sit in cash for a year. These are the things we can do that they can't do. It starts to make you think, well, that means there's going to be big chunks of time where I'm really not doing anything. During the time between, find the companies that you know are wonderful. Do your research, then, when the stock market drops, you'll be ready. What can you say about the stock market crashing? Are you ready for it? Let us know in the comments section below. And hey, if you enjoyed the video, don't forget to like and subscribe to our channel so we can continue giving you the best content. Thanks for watching, and we'll see you in the next video.